We're going to be talking about some things that are a little different than what we normally talk about. A lot of the times, when we have our guests on, we're trying to teach you guys how to get out of your W-2 job and get out of your desk job and get into the entrepreneurial frame of mind. But we've got somebody here today who's going to teach us how to maximize the benefits that we might have at a job from our ordinary income so that we can propel ourselves to the next level. So without further ado, let me introduce everybody to TR Smith. TR, why don't you give us a little bit about yourself and tell us a little bit about your background and what you're involved with?
Yeah, thanks for having me on the show. And, a few months back, I put out a book called Paychecks and Profits. And this was sort of the sum of all of my knowledge and experience in the world of personal finance. And, this was really my attempt to help people, whether they're specifically in the fire community or they just want to know more about personal finance, to sort of build their foundation of, not only how to invest, but where to invest, what type of account to be investing in to get certain tax advantages. And, I start off the book with a little story about how I finished college and I got my first full-time job and I got my first paycheck from that job. And I just thought, wow, this is not as much as I thought I was going to be getting, right? Because suddenly you're paying more in federal income tax, payroll taxes, state income taxes. You're paying, if you're lucky, you may have a good healthcare benefit or a 401k benefit. And all those things start to chip away at your take home pay. And, from that experience, I decided to really learn more about personal finance and, try to understand how I can leverage, the employer benefits and leverage that W-2 job to really make the most of it and to build wealth, using all the different strategies that other people are talking about. But I take a little bit of a different approach, which hopefully your audience will get a good taste of that today.
Yeah, I mean, that sounds awesome because I know everybody's like that. You get your first job and you're like, in your head, you're like, all right, I'm making $5 an hour. At least when I started, $5 an hour, 80 hours. You're like, man, this is going to be a nice $400 paycheck. And then all of a sudden, you're looking at 250 and you're like, wow, that's your first dose of reality on taxes and everything else. Um, so kind of give us the culmination of like what led you to here, to help people and all of that. Give us a little bit of your background.
Yeah. So, I'm somebody who, like a lot of your guests, has some good experiences with real estate investing, stock market investing. I'm not really a real estate guy, but I've had sort of my ups and downs and, just really felt like I wanted to give something back to, the entire personal finance world and hopefully, just give as much knowledge as I can to people who need it, because I think that what occurred to me was, after being in a couple of different jobs for big employers with different benefit programs, it dawned on me that no one else is really covering this in the personal finance space. If you search hard enough on the internet, you might find the answer to it. But in terms of really laying the foundation of what people need to know, it's more than just index funds and real estates and 401k. I mean, that's all great. People need to know that. But I wanted to take it a step further and really give people that sort of foundational knowledge of what to do. So, like I said, I've had, successes in real estate. I've had failures in real estate. I've had successes in the stock market. I've had failures in the stock market. I think we're all sort of old enough now that you mentioned having a $5 an hour job. I think actually my first part-time job was also $5 an hour. So we're probably dating ourselves a little bit in terms of whatever that minimum wage rule was at the time. It's probably a little bit higher for most people, but definitely I've been there. And I just thought it'd be exciting to share with people a little more information about how they can have that success. And also, when you read about even the basic stuff like 401ks, you realize that roughly half of all employees are not taking advantage of their employer plan, meaning they're not enrolled at all. And most employers are offering some kind of 401k match, which is basically free money, and they're not taking advantage of it. So I thought, this is my chance to help people out as best as we can. And I'm happy to dive into some of the specifics of 401ks and other benefits and sort of take this conversation wherever we want to take it.
Yeah, let's go ahead and jump into it. And I know as far as the matching goes, there's pretty much no better return you can have on an investment other than a 401k match because bam, immediately 100% match. Well, I guess it depends on the percentage that they're actually matching, but the return is great as long as you're, taking advantage of that. But yeah, let's go ahead and let you jump into it and just educate our audience a little bit.
Yeah. So, thinking about those W-2 jobs and, how to make the most of it, because obviously people may want to graduate from the W-2 job, but my advice is, really wring every dollar, every penny you can out of that W-2 job while you can. And so, yeah, I think the 401k sort of is the cornerstone for most people. And, the matching fund, it really is a question of, do you want to be retiring with $500,000 or $1 million, right? Or do you want to have $1 million versus $2 million when you retire? And that really is the question, because for a lot of employers, they will offer you essentially a dollar for dollar match. And so if you are putting in, let's say, $5,000 per year into the 401k, depending on your salary range, the employer may match that up to a full $5,000 or even just $2,500. But, it's going to be something that is significant. It is going to compound over time. And for people who maybe aren't in any kind of W-2 job at all, I also want to educate those folks too, to say, if you're choosing not to work for a bigger employer that has a 401k benefit, also understand what you're giving up, right? And that make sure you're getting enough of a salary bump that you're happy with that versus like the 401k. Because today we'll go through 401k, we'll go through other benefits as well, that really do add up. They really do compound on each other, where you can, earn a lot more money through these benefits than what people might think of just at first glance. So I'd say number one advice, understand the 401k benefit, get the full employer match, whatever that might be, whether it's 2%, 5% or more. So some employers will even do sort of a dollar for dollar match on whatever you contribute. Sometimes there's no cap at all. So if you put in the maximum, your employer may contribute something close to that as well. It just depends on how generous the employer is or how competitive that workspace is. So that's sort of my number one piece of advice. And if you want, we can also get into like Roth 401k versus regular 401k, but that's my first piece of advice for anyone listening to this.
So what are the current limits for a 401k? Because I've never had the opportunity to work at an employer who offered a 401k match or anything. I've always worked at smaller businesses or just for myself. But what are the current limits for those contributions? To get
Yeah. So right.
okay.
Yeah. So for a typical 401k benefit, you can go up to 20,500 in 1 year. So depending on what your base salary is, that could be, a pretty rich number. But for people who want to be aggressive, who are sort of thinking about that sort of fire mentality, you can go pretty high. And one of the benefits of it is, with the traditional 401k, you do get immediate tax savings on your account. Now, this is one of those sort of complicated things that I always kind of recommend people talk to their own tax advisor if they want to really understand it. But in broad strokes, what people should understand is that when you make it that 401k contribution, let's say for a particular month you're putting in $1,000, right? If you're paying roughly 22% federal income tax, now you're not paying that 22% on your $1,000 contribution, which means you're getting basically $220 back in tax benefits that you can spend on whatever you want to spend. That extra 220 benefits, that extra $220 that you get back is not locked up into some account. That's money back in your pocket you can spend on groceries or your car payment or whatever. So, it's really just this very powerful thing that allows you to reduce your taxable income. Some people may choose to go with a Roth 401k, which is a little bit different. We can get into that. But for people who are just starting out, who are thinking, how do I save on taxes? How do I begin saving? They should understand those benefits. So not only are you getting a dollar for dollar match, which is basically a 100% return on your initial investment, your initial contribution, you're also going to be getting that tax benefit right away, which is that little bit of incentive to say, hey, this is important. This is sort of the government is trying to be your friend a little bit. I have a line in my book where I say the IRS is your frenemy. And, you can't really avoid the IRS. They're sort of in your life no matter what, but they are trying to set up certain guideposts to help people build wealth. So they're not completely trying to crush you. If you understand the rules, you can put yourself at a competitive advantage versus somebody who may not know all the rules.
Right. Well, I can agree with that. I think the people who get the most upset about having to pay taxes are the ones who maybe don't take the time to look for all the opportunities that exist to not pay taxes, or just pay way less taxes, or defer taxes to a later date. So there's definitely a lot of strategies that you can get into there. And
Right.
along those lines, why don't we talk a little bit about the differences between the Roth 401k and the traditional, and kind of what that means to pick between the two?
Right. So the Roth 401k, and this is sort of similar to people who may use like a Roth IRA. But the Roth 401k, what it does is it lets you put money into the 401k. And instead of getting that immediate short-term tax benefit, what's happening is you pay all your regular income taxes on all the income that's applicable. And then when you eventually do retire, when you eventually build up this big nest egg, which hopefully will be, multiple millions of dollars of assets, when you actually do retire and you begin to take money out, at that point, that money will not be taxed in the future. So for a lot of people, that's very appealing if they're doing the math and saying, okay, in the future, I'm hoping to be a multimillionaire. I'm hoping to have a very high income as I get older. The Roth could be a good way to go. So if you don't mind taking that little bit of a hit in the short term, because you're not going to get that immediate tax benefit, you'll still get the employer match. You'll still get that long-term wealth creation. It's still, shielded from sort of the annual taxes you might pay, but then down the road, you're going to get that benefit from not paying taxes. And I believe the way the rules work is that, if you die and your children receive it, if they're receiving it as a Roth, then I believe they also do not pay taxes on it as well. So again, everyone can consult their own tax advisors and, and financial advisors, but ultimately there are some advantages to going the Roth route.
Right. So it just sounds like just to kind of summarize, the traditional IRA or the 401k is going to be a tax benefit today, and then the Roth is going to be tax benefit tomorrow. And the way I've always kind of thought about it is, especially with the Roth, because you're going to get those gains tax free in the future, it's a perfect vehicle to be a little riskier, I would say, maybe with your investments, because it's going to be a tax sheltered account in the future. So if you have all those capital gains accumulated in that, especially if you have a whole bunch of different wealth building vehicles, you got real estate, regular stock accounts, life insurance, whatever else, private company, private equity, private ventures, whatever. Your Roth is actually a really good place to make asymmetric bets too, and that's kind of how I look at it myself. Yeah, I don't know if you have any thoughts on that.
Yeah, I think that is a good way to think about it, because you are in most cases locking away the money until you turn like 59 or 60 or older. And I think that, knowing that is money you're not supposed to touch for the long haul, I think is a big benefit to people, at least psychologically, to think, okay, I'm in this for the long term. The market may do really poorly one year, but I'm not going to be trying to cash this money out, whether the market's good or bad. So I think that is a good piece of advice to give. And the other thing I'll just say on the Roth is that, whenever people are making this decision or weighing Roth versus, regular IRA or regular 401k, it is a little bit of a guessing game, because, if you're young and you're not paying a lot of money in taxes, the Roth might make the most sense, because you're sort of making a bet also that in the future, I might be in a higher tax bracket, and who knows what the actual, laws might be 20 or 30 years from now. Most people speculate tax rates could be higher in the future. So again, that's one reason people think, okay, I'm young, I'm going to invest in the Roth, and I'm going to get some savings down the road. The flip side is that if you're in a high marginal tax bracket today, and you're thinking, gee, maybe I'll just get the benefit today, and maybe down the road I'll be able to, use a tax code to save money anyway, the Roth might not have quite as big of an advantage to you. But either way, I just say that for people listening to this, just be sure you're opening a 401k, make sure you're at least getting the employer match and doing your best to save while you're young.
Exactly. And the nice part is you can actually contribute to both. So you can take advantage of your employer match and also contribute post-tax and pre-tax into your 401k so you can diversify. If you don't know which one you want to do, you can throw 3 or 5% here, 3 or 5% there, add your employer match, and all of a sudden 10% of your income is going into your retirement plan. And you're kind of offsetting it, by diversifying a little bit more into each. So, like you said, it really depends on what your long-term goals are, too. Because at a certain point, you're going to be required to start pulling this money out, and they just push that up, or pushed it back on everything. So they want people to have more money inside of their accounts, which could potentially drive them into a higher tax bracket. So it's I don't think anyone really has a crystal ball on what you should be doing. The biggest thing is you should be doing something instead of nothing, right?
That's right.
I agree with that.
Yeah. That's right.
Yeah, well, that makes a lot of sense. All right, so we have your 401k or your retirement plan that you could be doing if your employer offers it. Typically, when an employer is offering a retirement benefits plan, most likely they're going to offer you a FSA or an HSA or one of these other kind of health savings accounts. Are those beneficial to you tax-wise to participate in at your employer? Is that kind of like free money too?
Yeah, it can be. Usually it's not quite free money, but it is tax advantage money in most cases. So, I tell a story about my first couple encounters with the FSA. So FSA stands for flexible spending account. And there's actually two types of FSAs. There's one for healthcare, there's one for dependent care. In both cases, I kind of missed the boat early on because I just wasn't educated on this stuff. And I think a lot of HR offices don't do a great job of educating you. They might answer your question if you ask them the right questions, but if you're not asking the right questions, you might just be in the dark. So, on the FSA, I think the first time I was ever offered an FSA, I think they explained it in a very specific way. They're like, well, hey, if you have prescription drugs, if you have doctor visits or hospital bills, you can put money in the FSA and you might get some tax savings. And at the time I was young, I didn't have any prescription drugs. And I just thought, well, this doesn't sound like it's for me. I'm not going to really use this program. And it wasn't until years later that I realized that, oh, wait, there's this whole universe of things you can spend your FSA dollars on. So it's things like eyeglasses and contact lenses, which I was using at the time, but didn't realize that that was part of it. You can go on to FSAstore.com, or Amazon has an FSA store, and you can kind of just browse around and see, oh, I can get Band-Aids. I can get all kinds of stuff that are covered. So that was sort of my early experience. And then when I finally figured it out, I was like, oh, wow, I could actually max this benefit out and do quite well for myself. And so let's go through a little bit of the technical aspect of it. The healthcare FSA in 2022, the maximum contribution was $2,850. And what's special about this, and we'll sort of go through the tax rate example maybe more specifically here. If you're making even just 50 grand, 60 grand a year, you're probably paying at least 22% in your marginal tax bracket, which means that any dollar you can shield from federal income tax means you're going to save 22% on those dollars. And you're paying roughly 8% in Social Security and Medicare taxes too. So 22% plus 8%, now we're talking 30%, right? And in the book, I try to encourage people to think of that in terms of like, well, what else could I be doing with my money, right? Like if you put that money into a savings account, you might get 1% or 3%. If you find some other very safe investment, you might get up to 4% or 5%, or, that might be a stretch these days, but you might get a little bit more. And then same thing with the stock market. If you're lucky, you might earn 10%, 15% in a good year, maybe more. But the point is that, if you're thinking in terms of like, well, what if I filter my money through this special spending account or FSA, and I can save 30% without having to take any risk? That's what I try and get people to sort of think of that mindset, where it's like, gee, if I can make 30% today, that's a pretty good deal. So that's really what the FSA is meant for. It's been set up to encourage people to sort of save for whatever their healthcare needs are. And for people who have expensive routine healthcare bills, whether it's insulin or just, any prescription drug benefit or that they may need to take. This is the government's way of saying, hey, we're going to give you a tax break on some of these healthcare dollars that you have to spend. So Hopefully that makes sense. And I can also give a quick summary of the dependent care FSA. But I would just encourage people to really do their homework on this. Understand that you do have to use the dollars in the same year of the plan, right? So if you're getting to the end of 2023, for instance, you have to actually spend the money by a certain deadline. But beyond that, there's not a ton of restrictions on it as long as you know what the dollars can be spent on.
Yeah, and a
Yeah,
lot of
let's
times, I was going to say a lot of the times they give you a card for that. And like let's say you go to a CVS or a Rite Aid or a Walgreens, you can swipe that card first, and usually it will deduct the things that are in your cart off of that card, and then you can pay for the rest, that aren't like that. So you can start, utilizing some of that. A lot of the times it can also be used towards your copays, your insurance deductibles if you're going in for like a surgery or something like that, and you have a high deductible, like a high limit. So there's a lot of different things that you can go into that. I think we should touch on the dependent care real quick for people like James, who have a little one that might need daycare or also adult care on the opposite end of the spectrum.
Yeah, that's exactly what I was going to ask about. So let's talk about the dependent care a little bit.
Yeah, so dependent care. So in for that one, the maximum contribution is typically around $5,000 if you're eligible for it. And in most cases, if you have a child that is below a certain age, I believe the cutoff is around age 12. If they're in any kind of daycare program or private preschool or even after school daycare type programs, you can use this money for those programs. And so essentially it operates the same way as the healthcare FSA. If you filter in, call it $5,000. And I think most parents can probably attest $5,000 isn't that much in terms of annual daycare costs. So there's probably not too much chance you're going to spend under the limit. But anyway, $5,000, yeah, it's the same thing. So if you can make a 30% profit on it, and that's just kind of like, it could be even more than that. It could be closer to 40 or 50%, depending on your tax bracket. But let's just take that 30% number. You could easily have tax savings around $1,400, $1,500. So again, that's the government sort of giving you that money back and saying, hey, all you got to do is filter the money through this account, play by the rules, and you can get that money back. So again, and my own personal story on this was similar to the healthcare FSA. The first year I was eligible for the dependent care FSA with my firstborn child, I just didn't even know the program existed. I think it was one of those things where on day one of my job, somebody probably said, oh, this is a benefit to you. And I just wasn't paying attention. And, nobody called me when my child was born and said, oh, by the way, we have this benefit for you. So the first year I missed out on that tax benefit, but then somewhere along the way, I think my wife actually figured this out, that this benefit exists and we should sign up for it. And after that, we did get some good tax savings in the subsequent years.
I'm not going to lie, this is the first time I've actually heard about this. So,
okay. Yeah.
Yeah, it's news to me. I'm surprised they're not handing out pamphlets at the delivery room, which they should do, because that's probably the most important thing, to save on the medical bills that you're, having to pay afterwards. But that's really interesting. So I'm going to look further into that.
Yeah, and
you should have.
Yeah,
I was going to say, sorry. You should have Amy look into that. And usually you have to sign up for these benefits during the enrollment period, which is typically getting closer towards the end of the year. But for like real estate agents and different people like that, a lot of the times payroll companies, whoever's doing payroll, will offer some of these ancillary services, a small 401k or FSA type of things that can help with that. So because even if you're a small business owner out there listening, or an entrepreneur that has their own business, you can still qualify for some of these different types of tax savings plans and ways to go about it without having to work for a large company as well. It's not just a large company benefit.
Yeah, I believe that's correct. And, one more thing too, for the listeners who might be hearing this and might be excited about this, in theory, you can go lobby your employer or your HR office and say, hey, have you guys looked into this? Because there's a benefit to the employer too, because they also reduce whatever they might owe, at least in the payroll tax piece of it. So if they have got, a few dozen employees that sign up for this, and those employees are saving thousands of dollars in taxes, in a lot of cases, the employer will save a good chunk of money on taxes as well. So it can be a real win-win for employers that embrace this.
Are there any income limits for the FSA or the HSA? Or because I know with, like, for example, a Roth IRA, there's an income limit to be able to contribute to that, but you could otherwise, do your traditional Roth. Is there any kind of income limit with the FSA or the HSA?
Yeah, I believe for the FSA, there's no limit at all. The HSA is sort of a different benefit that we can get into, but I believe on the health savings accounts, which is sort of one more confusing acronym for the audience to keep track of. The HSA, I believe there's no income limit on that.
Yeah. And the reason why I know some of this is because I did work for a payroll company for about a year, and my job was specifically selling retirement 401ks, FSAs, and HSA plans to small businesses right in this little area. So, but that was a few years ago. I'm not an expert. I'm just saying I know a little about this type of stuff.
Right. Got it. Yeah. And if you want, we could even take a minute and just go through the HSA, because you mentioned it, James. So with the HSA, you've got now a health savings account, which it operates in some similar ways, but basically what the HSA is this extra benefit that is sometimes available if you have a certain type of insurance plan. Typically is called a high deductible health plan, or HDHP, which basically means that your monthly premiums are typically lower, but if you do get hit with a bill, there's a higher deductible. So you may have to come out of pocket, more than normal until you hit the actual deductible to pay for certain healthcare expenses. So for people who are young and healthy, it can be a good deal, but obviously if you're worried about some major healthcare costs, just make sure you have enough money that you're comfortable with whatever plan that you're in. So all that being said, the HSA is similar to the FSA, but the HSA actually offers what they call a triple tax advantage, which means, number one, when you make the contribution to the HSA, it is tax deductible, so you get tax savings up front. Secondly, it grows without any taxes. So if the money is invested, you don't pay capital gains or dividends taxes on that money. And then the third part of it is that when you actually withdraw the money to spend on healthcare needs, is not taxed at that point either. So it's actually sort of a unique sort of tax advantage account that in some ways is even more advantageous than like a 401k or IRA, because you're getting savings on the front end and the back end.
Yeah. And what's really, I believe, it's also kind of like a retirement, a health retirement plan almost, right? Where the money it rolls over every year, correct?
Correct. Yeah. So whereas going back to the FSA story, they expect you to spend the money every year. The HSA, you can leave the money in the account and you can invest it typically in sort of a mutual fund type account, and it will just grow year to year and compound year to year. So a lot of higher income individuals that understand these rules, they're going to contribute a lot of money to that because they see that benefit down the road. And then of course, when you need the dollars, you can still take the money out. And in retirement, as you said, a lot of people, their healthcare costs do go up in retirement. So it's nice to have this extra money that's available to you when you're older. And if there's too much money in the account, you can still access it. I believe the way it's set up today is you would have to pay some taxes on the withdrawal if you're using that money for non-healthcare expense. But all the same, you're still getting some good benefit out of that, even if you have to go that route.
Is there a point in time when you can use the HSA for something that's not health related? Like, can you use this as a retirement vehicle? Like, let's just say, like, I grow to be like 75 years old. I haven't touched my HSA. I haven't needed it for a health reason. Is there a reason to use, like, is there a way to pull out that money without having to pay a tax benefit? I'm wondering if there's any way to use it without having to use it for medical purposes after a certain period of time.
Yeah, my best understanding is the way it works is that you can still access the money, and at that point it would be treated like a traditional 401k or IRA, right? Meaning you got the tax benefit when you put the money in, you got the tax benefit from no annual dividend tax payments or capital gains tax payments. But then on the withdrawal, you're still going to have to pay now the IRS. So similar to a 401k or IRA in that regard.
Okay.
Yeah, and I think I think one of the important things for everybody out there that is listening to this is that, if you're working for a company that has more than 50 employees, they're offering all of these things to you, and you can piggyback them all together. You can participate in the 401k, you can participate in the FSA for things that are happening that year, and you can also participate in the HSA for things that might happen down the road by getting a high deductible or a high initial limit insurance plan because you're young and healthy and you don't plan on, being sick or having things happen to you, where you can save on the healthcare cost. And this does, I think, tie into, real estate investing and financial independence and entrepreneurship, because one of the main things that everybody involved in that likes to do is save money on their taxes and find ways to be able to keep more of your money, but still spend it on the things that you need to spend it on. And, healthcare and retirement are things that all of us, whether we like it or not, are going to be faced with at some point.
That's true. That's true. And then I have at least one more, really powerful benefit I want to highlight. I could talk about this all day, but I'll highlight at least one more. That in some ways it's like my favorite benefit, because it usually comes with the least strings attached, but sometimes it's also the least utilized. It's called the ESPP, or the Employer or Employee Stock Purchase Plan, ESPP. And basically what it does, most plans are structured where you can put up to 10% of your income into this special account where you can buy your employer stock. And typically every quarter they allow you to sell it. But the advantage is that you're able to buy it like a 15% discount, right? So if the stock is trading at $100 a share, you get to come in and buy it at $85 a share. And then on the day when you're prepared to sell it, you're now, you're selling it for a profit of at least 15%. And, this is the one that, again, the way most of these plans are structured, very few strings attached. You're not putting it into an account for healthcare needs or this is not your retirement account where you got to wait until you're older. This is literally, in most cases, every quarter. So every 3 or 4 months, you get access to your cash again, except now you've made a 15% profit each quarter. So the rough math of that is, 15% times 4 is roughly 60%. So if the math is a bit more complicated than that, but this is the back of the envelope math is pretty close here. Right. So, if you can put this money aside, you're going to make roughly 60%, 60% every year on this money with pretty minimal risk, because again, the day you sell the stock price could be up and down a little bit, but is it going to be down more than 15% or more than what your discount was? The odds of that are generally quite low. So, the odds are in your favor. So I would just say for people, if you have some faith that your company's a solid company, the stock price is not too volatile, again, similar to the 401k, roughly half of all employees just aren't taking advantage of this. So I would just say everyone should take a close look at this. I don't recommend people go into credit card debt, but if the question is, do I use my credit card that charges me 20% interest to take advantage of a benefit that might pay me 60%? I think that math is pretty easy for people to think about. So again, as the footnote to this, don't go into debt, don't get hit with taxes with fees and penalties on your credit card, but do what you can to really understand these benefits and maximize it. And while you're in that W-2 job, get everything you can out of it, and just do your best to create that wealth.
Are you finding that the employee stock purchase plans are typically available for just publicly traded companies, or are you seeing some private companies offer this as well for private equity in their businesses?
If it's specifically an ESPP, it probably is going to be just publicly traded companies, because it's sort of meant as sort of a liquid investment that you can cash in on. If it's not a public company, typically that means the company may still be privately held, so it might not be on the stock exchanges. But there could be advantages to just sort of buy into the the company stock, or in some cases you're given a grant, which can be a great benefit. I thought about adding a whole extra chapter or two of that in the book, but I felt like I'm going to, on this first book, I'm going to try and just keep it simple and encourage people to sort of get that free money, get that low risk money. And that was sort of my focus on the ESPP. But certainly you're right, James. There's a lot of different stock plans out there for people who can exploit that over a longer period of time as well.
Exactly. And I think that really just hones down the point of this whole podcast. It's just knowing what is available to you, what that giant benefits package really means when you get hired at that new company and you're all excited because hopefully you're going to be, making a little bit more money with a really great opportunity. And remember, companies sell you on their benefits package, on why it's a great company to work for, why you should need to work for us over some competitor. Is they're selling you on their great benefits package, but majority of people aren't even taking advantage of those benefits, which is dollars that you get to keep in your pocket and free dollars. Like you said, where else can you get, you put in 5% and they match you up to 5%, like where it's doubling your money. So I think that's really huge. If you wouldn't mind, what is the name of the book again, and the best place for people to buy it that helps you out the most? Is it your website, Amazon,
Yeah, the title of the book is Paychecks and Profits by T.R. Smith. Amazon's probably the best place to find it, although you can look on other websites as well. The website is also conveniently called paychecksandprofits.com. And if you want, I think at the end of the program, we can get into the contact information, but just for people who might be looking for that preview, T.R. Smith Invests is my username for like Instagram and TikTok and Twitter. People can find me there as well.
I
So,
love it.
so tell us a little bit about like what you're doing specifically to help people. Are you like running some sort of business where you're helping people facilitate some knowledge on this, or what? So kind of explain like what you're putting together for people.
Yeah, so I'm currently not running any sort of separate business right now. I'm purely an author, just trying to put the information out there. And then at the same time, similar to like everybody else on Instagram and TikTok, just trying to build my audience as best I can. So maybe down the road, there'll be some other business opportunities, but candidly, I'm not trying to sell anybody on anything besides my book, which is, between $4 and $10, which anyone who's enjoying this program and just wants to show their support, obviously would welcome any purchase out there. But but that being said, just genuinely trying to help people, just trying to build an audience. And, down the road, there could be other opportunities like that. But for the moment, just want to really give people that information and, help people, have success on the same path that I had success on.
It makes a lot of sense. It makes a lot of sense for anyone, for anyone out there really that, is looking to find out more information about their plans, like their specific plans and what their company is even offering. Like, who's the best person for them to reach out to typically at their company to even have these conversations about their own benefits?
Yeah, typically I find that, most HR employees, typically they'll have some title like HR benefits manager or even the head of HR. You could ask them, hey, I got some questions about my benefits package, right? Or, hey, open enrollment's coming up in a few months. I'd love to just get an early start on understanding what these benefits really are and what I can do with them. So I recommend that. Typically, there could be a website, either public or like a private intranet, where people can go on and look up these benefits too, and they can print them out and look at them sort of at their leisure. And certainly, for anybody who wants to message me directly, if they put the podcast name in the subject line, I'll be sure to put that at the top of my inbox this week if they have any questions on their plan. I'm happy to sort of look one-on-one if I have the time that week. I can at least answer some simple questions and even look at the full package with them and just say, hey, yeah, these are certain benefits that you should be looking at, and I'm happy to sort of give them some examples one-on-one as well.
That's great. That's great. Well, I think that kind of gives us a segue into our next part of the show that James and I like to call The big
Big
four.
four.
So James, kick it off.
So TR, why don't you tell us something that you do that kind of feels like a financial independence cheat code or a hack that really helps propel, your personal financial position forward? I know we discussed so many things that I'm sure you're taking advantage of, but what's something that maybe we didn't discuss that kind of really helps project your financial path forward?
Yeah, I think for me, it's, we talked about the tax advantage accounts. I think also having a good accountant that you can talk to can be kind of a good hack. My wife and I pay a good bit of money for our accountant, probably more than what we should, but I figure at some point we're going to make that up down the line. But he is someone that you can turn to. I remember when we bought our first house a few years ago. We've owned condos in the past, and then the tax laws changed around 2017, and suddenly the standard deduction was different. The mortgage interest rates were different. All these things were sort of changing, and so I called up my accountant. I said, "Are we actually going to save money when we buy this house?" And he walked me through it. And I won't give too much broad advice to people, but he explained, yes, you will get some tax savings, but it's not as much as it would have been a few years back, basically. And so it really is helpful to have someone like that who can sort of help you hack the system. So that's great. I don't know if this counts, but having a great spouse can be a great hack on your FIRE journey, or just your general investing journey. Somebody who's got your back, and somebody who's working hard with you. That's my other great hack in life, I guess.
That's one that is not said enough. I think we get a lot of
That is
tips and a lot of hacks. That's probably the most important.
that is the first time that that has been a hack for the podcast. So I love your answer, and I couldn't agree more. I could not agree more. Having a great spouse, someone who's on board. Awesome. All right, now number two, we like to call resources. So other than your book, are there any other books, podcasts, or people out there that our listeners would benefit from that has helped shape, your financial independence journey and mindset?
Yeah, definitely. I think for the FIRE mindset, one of the first books I came across was Playing with Fire. I think that was a pretty popular book, and they even made a documentary out of it. I thought that was pretty inspiring, just to sort of hear someone's personal story in detail about how they said, you know what, maybe we're spending too much money trying to live in San Diego and live in California, and just keep up with the rat race. Maybe we should just do something radically different. And that was pretty inspiring. I haven't left California yet, but that's a whole nother topic that we can get into if we have time. But that was something that was really interesting on the FIRE topic specifically. And then, just on investing, Tony Robbins has put out a couple of interesting books on investing. Even if someone doesn't love Tony Robbins, I'd say that the financial advice is pretty good, because he talks a lot about the ups and downs of the markets and how to ride that out. And that's been really useful to me. Just whenever I'm picking up the newspaper or looking at CNBC.com or whatever it is, and I'm just thinking, oh man, what is going on in the market today? But to have the right mindset of, okay, how do we ride this out and make sure we're not selling at the wrong times?
Yeah, I've tried to adopt a new philosophy of not selling as much as possible, because selling anything that I've ever owned has always been the biggest mistake I've made.
That's so
Investing.
true. That's so true.
I never bought anything I regretted. I've always sold something thinking I was smarter than somebody else. Ended up not being true.
That's very true.
I can
That's
agree.
very true. Yeah.
Yeah.
Can
So,
agree.
TR, along those lines, you kind of mentioned getting out of California. So let's give you the opportunity to expand upon that a little bit. This one, we're going to be asking you about your future you. So paint a life 5 years in the future, either business-wise or personally. Where's TR Smith at? And like, what are you doing? What's your life look like?
Yeah, 5 years from now, realistically, I'm probably still in California. But if the stock market is at least a little bit up each year, there's a chance I could be sort of like work optional in 5 years. I think that the biggest challenge is sort of that lifestyle creep, where it's like, okay, well, we like the neighborhood that we're in, we like the house that we're in. But now it's like, okay, now we got to support this particular level, right? Unless you're really ready to downsize or make some decisions. But but all that being said, despite the mortgage, despite the California taxes, we're still saving money every month. We're still pretty happy with that situation that we're in. We have a daughter who's in sort of a private daycare / preschool plan right now, but I could see in 2 or 3 years, some of those expenses start to go down, which hopefully frees up more money for saving and investing. So that's kind of where I am on that 5-year path.
Yeah, I just started my child in daycare maybe like 3 weeks ago, and already now it's hitting me like, wow, if I have another kid, this is going to double. And then a third
Yeah.
kid, and then so you go through that process for about, I don't know, 7 years, depending on how many kids you have. And then all that money frees up, and then you get to spend that money, hopefully doing more financially productive things, I'll say.
Yeah.
So yeah, that's something that I'm kind of thinking about.
Yeah. No, yeah. And James, that's actually a pretty profound statement, because I remember one of my coworkers who also helped me understand some of these FSA benefits and stuff. She had 3 kids, and at the time, I think when I had the conversation with her, we had just one child, and we had a private nanny, which we knew was expensive, but we were thinking like, okay, after the first 12 months, we'll probably end up in daycare. And then she mentioned to me something so simple that you just said, which is, well, when you have 2 kids and then 3 kids and then they're all in daycare, like you're just, that might be even more than the nanny. And I hadn't really done the math where I'm like, oh, wow, that really does add up fast, doesn't it? Right. And even if they're in first grade, you might be paying for like the after school daycare, and, or you're paying for like a part-time nanny on top of all the other expenses that you're that you're covering. So yeah, that is kind of a profound statement. And that's why, people should really just do the math when they're planning, when they're going to have their kids. Just really do the math of what it's going to cost you, and how, and if you can save money somewhere, do your best to do that.
I keep telling my wife we need to have as many kids as we can, as quickly as we can, so we do it before we have time to regret it. What that means is doing it before we have time to crunch the numbers.
Right. Yeah.
I love it, James. Sometimes decisions are based on emotion and not the numbers.
Yeah. Yeah.
And with that being said, I know you've already told everybody, but where's the best place for people to get in touch with you? Your Instagram, the website, and the name of the book one more time.
Yeah, Instagram, TikTok, and Twitter. It's all TR Smith Invests. People can send me a direct message or just post a comment. I'm always happy to have new followers and new people commenting on the content. And the website is paychecksandprofits.com. A lot of the material that is in the book I've put out there basically for free in blog format, just because, again, my goal is to give people the information. There's not a ton of secret sauce. I'm not selling anybody a special, I'm not selling anybody a mutual fund or something special. I'm really just trying to give people the information and curate the information in a way that makes sense, right? So the theme of the book is mostly based around employee benefits, but if people found this conversation useful, the book goes into more detail on things like state income tax, custodial accounts, 529 college accounts, which I'm guessing James already knows a lot about this, but if you don't, I'm happy to talk to you about them, or you can grab the book too. But yeah, again, I'm just excited when people, when people have that light bulb moment. That's exciting for them. It's exciting for me. And it's always great when people have, feedback, whether it's from this podcast, if somebody found me from this podcast, would love to hear from you, and, just hear what your situation is too.
Well, it just sounds like your book would be a great resource for anybody who's literally graduating college or high school and about to get a job working for a company. I mean, it's a lot of really important information that people just gloss over or just aren't adequately informed of for one reason or another. So
Right.
definitely a giftable book, in my opinion, to someone you care about who's ready to start making good financial decisions.
That's right. Birthday, holiday gift, graduation gift. Graduations are coming up.
Yep,
so
graduation especially. Yeah.
There we go. There we go. All right, you guys know the drill. If you like this podcast, If you want more podcasts like this, where we're informing you guys about important information, not just, building your real estate dreams and goals, send us a DM, let us know, leave us a review, hit that like button, hit that subscribe button, and we'll catch you next time. See ya.
See you guys.
Thank you for listening to the Real FI podcast, where you learn from the investors that have lived the hard lessons for you. To connect with us during your pursuit of financial independence, be sure to join our community by following us on Instagram or emailing us at info@therealfi.com. If this content made you financially, mentally, physically, or spiritually richer, please make sure to leave us a positive review on your preferred content platform. Cheers to kicking the 9 to 5.